Over the last year, many people have been hoping mortgage rates would come down before they bought a home. But will that actually happen? According to the latest forecast, experts say rates will decline, but not as much as a lot of people want. The good news? Even if they don't drop substantially, there are still ways to make buying a home more affordable. Hey there, I am Christina Sparks, realtor with Real Broker, owner, House of Sparks. So, the burning question, how much will rates actually drop? A few months ago, many experts were forecasting mortgage rates could get below 6% by the end of 2025. But recent projections suggest that may not happen after all. While mortgage rates are still expected to decline a little later this year, projections from Fannie Mae, the Mortgage Bankers Association, and Wells Fargo now show them stabilizing closer to 6.5% by the end of the year. With that news, let's talk creative financing options in today's market. Since rates aren't expected to decline as much as originally expected, it may be worth considering alternative financing options that could help you get into a home sooner than later. I'm going to go over 3 strategies to discuss with your lender to see if any of these make sense for you. Number 1, mortgage buydowns. A mortgage buydown allows you to pay an upfront fee at closing to lower your mortgage rate for a set period of time. This can be especially helpful if you want or need a lower monthly payment early on. In fact, 27% of agents say first-time homebuyers are increasingly requesting buydown fees from sellers in order to buy a home right now. Number 2, adjustable rate mortgages. Adjustable rate mortgages, which are known as ARMs, typically start with a lower mortgage rate than a traditional 30-year fixed mortgage. This makes them an attractive option, especially if you expect rates to drop in the coming years or plan to refinance later. And if you remember the housing crash, know that today's ARMs aren't like the risky ones back then. Lance Lambert, co-founder of Resi Club, helps drive this point home by saying, ARM products today are different from many of the products used in the mid-2000s. For 2008, lenders often approved ARMs based on borrowers' ability to pay the initial lower interest rates. And sometimes they didn't even check that. Remember Ninja loans? Today, adjustable rate borrowers qualify based on their ability to cover a higher monthly payment, not just the initial lower payment. In simple terms, banks used to give loans without checking to see if buyers could afford them. Now, lenders verify income, assets, and jobs, reducing the risk associated with ARMs compared to the past. Number 3, assumable mortgages. An assumable mortgage allows you to take over the current owner's existing loan, including its lower mortgage rate. And with more than 11 million homes qualifying for this option, according to US News, it's worth exploring if you want or need a better rate. Here's the deal. Waiting for a big decline in mortgage rates may not be the best strategy. Instead, options like buydowns, ARMs, or assumable mortgages could make home ownership more affordable right now. If you're looking for a lender, down in the description box, you can access my personal list of lender recommendations that can help guide you in whatever direction fits your needs. Have questions? Feel free to reach out. I'm happy to help any way that I can. Have a great day.